Here's a riddle for you. How can a country sitting on the world's largest oil reserves produce so little that it's barely a blip on global charts? Well, that contradiction is exactly why we're here. This is a story about a geopolitical standoff, sure, but it's really about the quiet, powerful ripples it sends through the entire global economy. Okay, let's break this down.
First, just look at this number, 303 billion barrels. That is the size of Venezuela's proven oil reserves. It's officially the largest on the entire planet. To put that in perspective, that's more than Saudi Arabia. It is a truly staggering amount of energy wealth just sitting there, locked underground.
And that right there brings us to the central puzzle. Despite sitting on all that oil, Venezuela is currently pumping out less than 1% of the world's total supply. So you have to ask, if the physical barrels themselves aren't really moving the needle, why should we care about a geopolitical flashpoint that seems so isolated?
Well, to answer that, we're going to trace the entire chain reaction. We'll start with what's happening on the ground, unpack this Venezuelan paradox, and get into a really key concept called the risk premium. Then we'll see how that ripples into inflation, how it hits different countries in different ways, and finally, what it all signals for the road ahead.
So first up, the immediate trigger. The situation has heated up recently. We're seeing a real escalation in U.S. pressure on Venezuela, and it's moving beyond just financial sanctions to direct action, right there in the Caribbean.
And you can see just how quickly things have escalated. In late 2025, the U.S. went from seizing a single tanker to announcing a full blockade and then slapping tariffs on any country buying this oil. This isn't just about sanctions on paper anymore, we're talking about physical intervention at sea.
All this new tension brings us right back to that core contradiction I mentioned a minute ago, what we're calling the Venezuelan paradox.
And this just lays it out perfectly. On one hand, you've got the world's largest reserves. But on the other, production has completely collapsed. We're talking about a fall from over 3 million barrels a day back in 2000 to less than 1 million today. It's a tiny fraction of global supply, all thanks to decades of mismanagement and sanctions.
But wait, there's another layer of complexity here. Because you know what? Not all oil is created equal. Most of Venezuela's oil is what's called extra heavy crude. The best way to think of it is like molasses. It's super thick, it's full of sulfur, and you need very specific, very expensive refineries to turn it into useful stuff like gasoline. This is not the easy stuff to get out of the ground.
And because it's so specialized, only a few places in the world can actually handle it. This has created an unbelievable dependency. A staggering 80 to 90% of all of Venezuela's oil exports now go to just one country, China. So what happens when your entire export economy basically depends on a single customer?
Okay, so if the actual physical supply is so small, what is the big deal? Well, this brings us to the key economic force at play here, something called the geopolitical risk premium. Really, it's all about pricing in fear.
A risk premium has nothing to do with a current shortage of oil. It's the extra money that traders add to the price of a barrel today because they're worried about what could happen tomorrow. It's kind of like insurance, right? You pay a small, regular premium to protect against some big potential future disaster. That's exactly what the market is doing with oil prices.
And here's how that fear actually turns into higher prices at the pump for you and me. Tensions rise somewhere like the Caribbean. Traders, they start betting that this could disrupt supply down the line, and that pushes up the price of oil futures contracts. That higher cost then just gets passed right down the chain to refiners and eventually to us.
So right now, how much is this fear actually costing us? Well, the market is pricing in a pretty modest risk premium, about $1 to $3 per barrel, specifically because of the Venezuela situation. It's a clear sign that traders are watching very closely, but they are not panicking. Not yet, anyway.
And the big reason for that calm is right here. The world is basically swimming in oil at the moment. We have a global surplus of around 2 million barrels per day. This huge cushion, this buffer, means the market could easily absorb the loss of all of Venezuela's production without really breaking a sweat.
But even a small, sustained price increase matters. So let's trace how that risk premium can ripple outwards and eventually show up on your grocery bill.
Just take a look at this breakdown. A sustained 10% jump in oil prices doesn't just raise the price of gas. That's the direct effect you feel right away. It also creates these second-round effects by making it more expensive to produce and transport, well, almost everything else. I mean, think about it. Higher fuel costs for the tractors harvesting our food and for the trucks delivering it to the store. Those costs have to go somewhere, and they get passed on, pushing up overall inflation.
And that inflation presents a really tough dilemma for central banks like the Federal Reserve. What do? Do they raise interest rates to fight that inflation, even if it means slowing down the economy and hurting jobs? Or do they hold steady to protect growth and risk letting inflation run a little hotter? Honestly, there is no easy answer.
Now, this is absolutely crucial to understand. The pain from these price ripples is not shared equally around the globe. Not at all.
This shows the stark divide. For developing countries that have to import their oil, higher prices are a complete nightmare. Their trade balance gets worse, their currency gets weaker, and they're often forced to raise interest rates, which slows everything down. But for the oil exporters, it's the exact opposite. They get a massive windfall.
And you can see this in major economies like India, which imports 85% of all the oil it uses. Or look at Turkey, which has a history of its currency getting hammered whenever oil prices spike. For them, a political flare-up thousands of miles away can trigger very real, very painful economic consequences at home.
So let's bring this all together. What does this situation really signal for the global economy? To do that, it's really important to have some historical perspective.
The huge oil shocks of the 70s and 90s were so catastrophic because they took something like 4 to 5% of the world's oil supply offline, and they did it in a market that was already tight. Today, even a total loss of Venezuelan oil represents less than 1% of supply in a market that has a massive surplus. This is absolutely not a repeat of the 1970s.
So, what are the key things to remember from all this? First, and most importantly, this is a story about the fear of a disruption, not a real physical shortage. Second, that super specialized heavy crude adds a tricky wrinkle for some refiners. Third, the biggest economic pain from all this is felt by vulnerable emerging markets. And finally, the most critical variable, the thing that will really determine the outcome, is how central banks choose to react. And that leaves us with the final thought. The real question here isn't whether some huge oil crisis is coming. It's not. Instead, the real challenge for the global economy is how policymakers will navigate the subtle but very significant financial and inflationary ripples from a conflict that, on the surface, seems deceptively small. It's a test of precision for them in what is a very, very interconnected world.